And we can now move to the last part of today's conference, which is going to be the roundtable panel discussion on advances and challenges in asset management. And this panel is going to be moderated by my friend and collaborator, Théodore Economou. Théodore is a very well-known professional worldwide. He's also an IFFR fellow. He's a board member in various well-known institutions. He's a member of the investment committee of the Virginia Retirement System, one of the biggest pension funds in the world. He's also a board member of Eurobank Private Bank Luxembourg. He has activities in Middle East in various funds, and he's also very sound academically. He holds an MBA from Northwestern and a degree from EPFL in Lausanne. Théodore, thank you very much once again for your participation and assistance. And the floor is now yours and to your four wonderful panelists.
Thank you very much, George, for this very nice introduction. Let me welcome everybody and say good afternoon for this closing panel. As you all know, and as you witnessed listening to the presenters earlier today, this conference occupies a unique slot, and that is to bring together regulators, academics, and practitioners, which is highly unusual to get all these together. And the aim is to give practical advice to asset owners and fiduciaries. So in this spirit, in this panel, we aim to be insightful, slightly provocative, but most of all offer very practical advice to asset owners and allocators. And I'm pleased that among our audience of more than 400, there's a very large number of you that control significant pools of assets. Now, for this purpose, we have four highly regarded professionals that I'm very honored to moderate, and they will share with us their views on how to succeed in 2026. Let me introduce them because I'm really enthused about the skill set we have here. And I'll start with Nektarios Papagiannakopoulos, who's head of alternative investments at Alpha Asset Management, and who is a specialist of equity, both long only and importantly also long short strategies. He started his career in sell-side research more than 3 decades ago, which is probably a fantastic school for investing. And he has a fundamental value-oriented approach, including turnaround situations. So he's perfectly positioned to tell us about the long-term forces, how these apply, and how they should be estimated, evaluated in this new environment that we're dealing with. Nektarios, welcome to this panel. Next, we have Panagiotis Chronas. Panagiotis is portfolio manager at IOLCUS Investments. He's truly a seasoned alternative investments professional, serving both institutional and individual investors. He focuses on portfolio construction and management, including, of course, due diligence and research. He started his career with Alburn Partners, a very well-respected group that many of you probably know. And he has a track record, I have to point out, of innovation. Latest example is that IOLCUS launched a new hedge fund, which is domiciled in Greece. And that's the very first hedge fund under the updated local OEE structure. So truly an example of innovation. Welcome, Panagiotis.
Thank you, Théodore.
Next is Konstantinos Foteinopoulos, who's portfolio manager with 3K investment partners. Konstantinos has that very, very rare combination of having both quant and fundamentals expertise. He also has a very broad view on the markets, leading on investment strategy, portfolio architecture, as well as risk. And he also has an international footprint, participating in European regulatory consultations on a number of topics, including sustainability reporting. Again, very well positioned for this global world that is changing so fast. Welcome, Konstantinos.
Thank you for having me here.
Welcome. And then we have Evangelos Memos. Evangelos is head of discretionary portfolio management at Piraeus Asset Management, the large Athens-based asset management firm. He has 3 decades of experience, having served both as an investment manager and also in very senior positions in managing asset management firms. Interestingly, he has combined expertise not only in investment management, but also on the regulatory side, the compliance side, and risk management, which is again an unusual combination, but that brings terrific perspective in managing assets. He also has a distinguished academic series of credentials, both from Greece and from the UK. Welcome, Evangelos.
Thank you very much for the opportunity to speak with you today.
Thank you. Let me start this panel with the macro picture. Last week, for those that listened to what happened in Davos, Bridgewater's Ray Dalio spoke of a new monetary order. StoneX, Vincent Deluard, speaks for the last 3 months at least of the emergence of the age of fiscal dominance. And just last month, Mohamed El-Erian wrote that normal distributions in this new world have been replaced by fat tails. And we just heard from Maria Vassallou, and I quote her, that we are in a world where everything we knew has changed. So my first question to you is, do you agree that the world is going through a transition towards a new phase of the long-term cycle? And if you agree, what is it that characterizes this new phase? Evangelos, I will start with you. Do you buy this?
All right. Thanks for this question. It's not an easy answer. However, I'd like to leave you with this. We're not in a normal market cycle. We are in a structural transition. This is the end of the cheap everything era. Over the past decade, markets benefited from an extraordinary supportive configuration. Growth was powered by cheap labor through globalization and China integration into the global economy, cheap capital through persistently falling interest rate, cheap and stable energy, and a relatively light regulatory and geopolitical friction. This era is now ending. Plus, demographics alone represent a profound shift in more major economies. Population are aging, workforces are shrinking, and dependency ratios are rising. So, we'll put it simply, the last decade was built on abundance. The next one is built on constraints. What characterizes the new phase? I would say less smooth, more political, more constrained, and more strategical, I think. The past decade rewarded investors for one dominant behavior: own long duration, own growth, ignore volatility. That playbook no longer works. Inflation becomes something to manage rather than suppress entirely. Capital becomes selective again. Hold rates rise, leverage matters, and real returns matter also. More, the state plays a larger role, not through full nationalization, but through industrial policy, strategic subsidies, infrastructure investments, and defense-linked innovation. So the boundary between markets and government shifts. And growth increasingly comes from technology applied under constraint, not from expanding consumption endlessly, but from doing more with less. AI and automation offset labor scarcity. Energy systems are transformed. Fiscal systems, factory grids, logistics are digitized and optimized. Historically, these transitions are messy, but they are also fertile. They lay the foundations for the next phase of sustainable value creation.
So Evangelos, thank you. You listed a number of changes, and they echo the theme of that we heard from Maria Vassallou. That said, there are long-term forces that drive capital markets. Where are we? I'll turn to Nektarios. Where are we in the cycle in terms of these long-term forces? Are these forces changing? Is this what should drive a different phase of the cycle going forward?
Thanks for your question, Théodore. So I will argue. I will agree with the term that you mentioned about the transition earlier on. But I will say that it doesn't really matter if it's a new economic cycle or not. Surely it's a kind of a prolonged economic expansion, especially in the USA. But I will argue about this realization. There's the same old paradigm, regardless where we are exactly. The same key long-term forces, as you mentioned before, they continue to apply in this economic cycle. We see them within equities, and we see them across sovereigns, rates, or fixed income. Within equities, we see the same traditional qualities. They are unchanged. If I should use only one, it's about pricing power. There is a new industrial policy, perhaps, set by the sovereigns. There are business opportunities. There is M&A and consolidation. There is innovation, technological innovation, and so on and so forth. But it's always about pricing power, about the earnings generating capacity and the quality of those cash flows and the resilience of those cash flows. So we still try to assess whether or not these earnings are mispriced in their valuations. The same old paradigm. Across rates, one more thing. We do observe the same long-term forces as well. It's about growth, nominal or real growth, real yields, like the discussion a while ago, demographics. It's, of course, about geopolitics. It's more about geopolitics today than before, just like Evangelos mentioned before. But it's also about the debt stock. There was severe price action very recently about policies, fiscal policies, the debt stock, and refinancing of those new policies in the not too distant future that shocked the markets. So the same old forces are still there. There's one more thing which is new. It's the fiscal dominance that you mentioned before, Théodore. The fiscal dominance means that governments may have more tolerance about higher debt stock, about lower currencies on real terms, and of course, the unpredictability of this situation is that governments tend today to determine or drive the potential outcomes more than before. So this is creating some form of unpredictability and volatility in the markets.
So if I listen now to our first two views we heard, on the one hand, we seem to agree that we are entering into a new phase. Certain things that we took for certain will not be certain going forward. Yet at the same time, what you're arguing, Nektarios, is that we have a number of tools as investors that we should keep using and still refer to some of these constants in the market that are driving capital returns. Now, let me turn to Konstantinos as a portfolio constructor, as chief investment officer for a number of portfolios. How do you put all this together?
Yes. I strongly believe that a proper diversification is going to gain more traction in this new phase or so-called new era. And I think due to the fact that I have served both roles as an asset manager and as a member of the investment committee, I increasingly see that institutional investors have turned to alternative and non-traditional investment solutions to achieve a meaningful portfolio diversification. I think this is the key in order to improve risk-adjusted returns, and enhance asset liability alignment. There are many solutions here. We can talk about them: the private markets, the alternative credit, the multi-asset strategies, the factor-based investing, and real assets, which extend the diversification benefits beyond traditional equities and bonds, sovereign bonds, by introducing differentiated risk premia, cash flow structures, and economic exposure. So, and from an insurance company perspective, if I may say, when integrated within an asset liability management and the regulatory framework, these solutions offer portfolio resilience because it is very crucial for them, capital efficiency, and long-term financial stability. So in this kind of turbulence, I think we have to have a steady pillar and to see how to properly diversify our portfolios.
Thank you, Konstantinos. I really want to dig deeper into this topic and be as specific as possible. particularly with regards to equities and fixed income and the changing roles they have in the portfolio. But I want to turn first to Panagiotis because you referenced Konstantinos alternatives, and Panagiotis is an alternatives specialist. It's his world. I'll echo Maria Vasalou, who said that emerging markets doesn't mean anything anymore. And one could argue that the word alternatives doesn't mean anything anymore because it means anything and everything. So how should an allocator, an asset owner, look at adding alternatives or increasing the alternatives allocation to a portfolio, Panagiotis?
So echoing what's been said before, it all starts with understanding where a portfolio is currently and where the portfolio should be moving towards. So alternatives, as you just said, can be anything and everything and can offer more or less anything and everything to a portfolio. They can be risk mitigators, they can be return enhancers, they can give exposure to asset classes that are otherwise inaccessible to investors. And one of the main key trends that we've been seeing here at IOLCUS and we are extremely excited about is the innovative trend of democratization of alternatives. So this is a trend that's interestingly enough supported or even borderline prompted by regulators, which is why it's been so prevalent. And it basically gives non-institutional investors access to private market asset classes like private equity, like venture capital that can be return enhancers, like private credit that can aid insurance portfolios when it comes to balancing assets and liabilities. And while all of these tools have up until now only been meant for institutional investors, individual investors can also access them. So that's definitely
So I hear
yes.
you. I hear you. So what you're saying is the access issue is being democratized, and that's fine. That point is taken. The question is, within the universe, what should one do? Should one be, I'll echo Konstantinos, highly diversified, or should one dig deeper and express a conviction? And if so, where and how and where is opportunity?
So conviction is always important, but that doesn't mean that we shouldn't be starting from a well-diversified portfolio. If an investor isn't more or less certain about what would happen in an adverse scenario, by having an already well-diversified portfolio, which can be accomplished using absolute return strategies, long-short strategies, and hedge funds that tend to behave better during periods of adverse economic events. Once that's completed, one can look more towards adding more targeted exposure to asset classes where they have higher conviction in. For example, we all know that in alternatives, it's not just about choosing the right strategy, it's also knowing about how to choose the right manager and having access to said manager. Dispersion of returns is extreme. So when one has to dig deeper and initiate positions that are definitely a little bit more targeted, they have to have both a high conviction towards the strategy itself and the manager that's going to be called to execute the strategy. So for portfolios that want to be better allocated in this world, they can look towards more niche strategies that take advantage of certain trends that have been occurring, like the higher issuance of convertible bonds that can be taken advantage of from managers in the convertible arbitrage space in hedge funds, or M&A being resurgent in the past year, especially compared to the couple of years that preceded that. One could look towards risk arbitrage and merger arbitrage. So there are definitely hedge fund solutions for basically every type of portfolio. And whenever an investor wants to express a higher conviction, as every investor should in every environment, there are definitely both the tools and the managers to do so.
Okay, thank you, Panagiotis. So you've identified a number of strategies that are worth looking at. I'd like to turn to Evangelos and ask him, within these very specific recommendations for looking at specific strategies, What is it, if you look at capital flows in equities, what is it in that would lead you to favor certain strategies, certain exposures? What should allocators look at in terms of capital flow trends?
Well, the era has changed, so there's no the same thing as it was before. For example, high grade sovereign debt is not risk-free rate as it was before. The equities is the same thing. There are several risks ahead. There are three structural forces for me who dominate equity returns. The first of all is the fragmentation over globalization. Margins will compress for global exporters, but expand for local champions with protected markets. This has become lately very obvious. The second one is that we should have capital discipline over growth at all costs. Nowadays, shareholder returns, dividends, and buybacks matter again more than before. Cash flow is back in fashion. The third one is that demographics favor companies that substitute capital for labor, automation, AI-enabled services, and advanced manufacturing. Equity beta alone will not deliver as it was. Dispersion is rising, which favors active selections. So in this universe, we have to be more selective, and we have to take into account several risks that we look ahead, such as the policy missteps, financial stability risks, geopolitical risks, and valuation risk itself. Several asset classes are priced for benign outcomes at a time when macro uncertainty is structurally higher. Equities premium in developed markets, it's below long-run average, and valuation concentration is extreme. So we have seen that a small group of mega caps companies have huge influence on global benchmarks, compressing risk premia and increasing index fragility. And when the risk compensation is thin, outcomes become asymmetric, and that matters a lot in our portfolios. So we have to be more to give more attention to valuations, to politics, to geopoliticals, and to have a high diversification in our portfolio. Value exists where expectations are low but strategic, and relevance is high, such as energy and energy infrastructure, defense and aerospace, luxury, industrial automation and electrification, and all these new sectors that have come into fashion lately.
So let me stop you here and ask our other panelists to share their thoughts, because what I see here and what I've heard is a fundamental conflict between two views. On the one hand, I hear that we need to have significant diversification, a word that came up time and again. And on the other hand, I hear that there are specific themes that are emerging in this new world that will shape capital flows and that need to be favored. So which is it? How do we position ourselves in a market where, the US market is 65-70% of global capitalization? Emerging markets is underrepresenting the indices, but probably if we add China, at least half as large or more. What should we do? Help me, Nektarios.
Yes, Théodore, thank you. So I like this question. When we talk about diversification, what we really mean is I would call it the underlying diversification. So we don't really care about instruments per se. It's about risk. It's about exposure to different potential outcomes within the portfolio. So that's what we are after. We're trying to reduce high correlations, which are still there. We're trying to reduce trend following, which is quite often irresistible, but it surely amplifies the impact in any kind of drawdown. But it all comes together by what we discussed, what everybody talked about earlier on. It's about understanding the global shifts, looking at the macroeconomic tailwinds. So from there, we can build the underlying exposure to specific risks and opportunities, be it a hedge for inflation, a shield from volatility in the public markets. When we look private markets, I think Panagiotis alluded to that at some point. We may offer asset owners different alternatives with different risk tolerance or time horizon. So we can combine all the goods from both worlds, really.
So let's dig a little bit deeper in that. Konstantinos, we all built our models, our portfolios. We have built our portfolios typically on time series that we all obtain from vendors and that typically go back 5, 10, 20 years. And some of the more less granular ones up to 40 years when databases started to be really built. You have quant and fundamentals expertise. What should guide us in this new world? Should it be the quant series that we adapt, that we intervene in? Should we leave them as they are? Should we adjust for fundamentals? What should we do with all this data that is available, but we could use in 10 different ways?
Yes, I think all these factors do matter. I mean that the fundamentals are the foundations of the principles, and we as a company believe strongly in these principles because the fundamentals help you to alleviate any noise, and sometimes the system becomes a little bit more stressed, or you see some asset bubbles, the momentum of these bubbles going on, and you think maybe I have to fall and to buy a specific percentage or to increase a bigger weight in order to follow the trend. So we need the fundamentals just as a reality check in this procedure, but we cannot also underestimate the quantitative analysis and the adapt that we have to do. But the crucial thing here is not only the principles or the dimensions of through fundamentals or through quantitative. It has to do with the investor, the features of the investor. It is other characteristics has a retail investor, other characteristics has an institutional investor, and the institutional investors. I think that we have to separate between asset managers and institutional owners, and especially insurance companies and pension funds, that they have to take into account other factors as well. Insurance companies have to take into account the Solvency II framework, or they have to know about the cash flow structure that they have. So it is not one solution fits all here. But I think that we have to adjust the investment procedure according to the needs of each investment that we have to handle.
So let me challenge you here because, and I'd like to hear from our other panelists also to pitch in. I'd like to come back to equities. Insurance companies can invest in equities. They can invest globally, maybe not as much as they would like to, as they should, they theoretically should, but they can, right? And obviously pension funds are overweight equities because they need that growth component, at least those that are not fully funded. If I look at equity allocation today and I look at fundamentals, okay, what do I see? I look at European allocation where, GDP in Germany has been declining. Government balance sheets, country balance sheets have too much debt. Growth has been below trend. And on the other hand, I look at Asia in a 3,000 kilometer circle around, China, which includes the Middle East, where we see growth, we see abundant natural resources, we see a labor force that is increasingly well educated, yet significantly cheaper than elsewhere. And typically in our portfolios, emerging markets and that area that I mentioned is, in the best case, 20% of allocation. Typically, if we follow indices, probably around 15. Should that change? How?
Yes, as from an asset manager perspective, due to the fact that we have some clients in in the insurance framework and pension funds. We try to influence, the investment committee just to change a little bit the strategic asset allocation, because many of the pension funds have a very conservative strategic asset allocation.
I hear you. I hear you about the politics. My question is, what would you do? What is your conviction? And this is addressed to all the panelists here. What is your conviction? Should we stray away in equities from following the index index-weighted allocation for geographic weights? And please pitch in if you have a view.
Yes, I agree that we have to adapt and we have to increase the flows towards these zones that you mentioned earlier on, due to the evaluations and of course, other features that we see, the growth rates that many of these countries deliver, or the fiscal room that they have, which is more ample. They have more room in comparison with developed markets and developed societies. So personally, I agree, and I'm strongly of the opinion that we have to rotate a percentage of our investment buying power to these geographical zones. And I think that this new area that you mentioned earlier on has these characteristics. I believe that we're going to see increased volatility and increased speed of asset rotations on a geographical and sectorial basis. So my short answer is yes. I believe that we have to adjust our basic structure towards these zones in a bigger way. Yes.
Evangelos, can I turn to you? You spoke about the long-term cycle. Would you agree?
Yeah, definitely. I think the most underestimated risk now is the correlation breakdown. Many portfolios have been built on assumptions that bonds hedge equities, that liquidity appears when needed, and that volatility is temporary. While this stresses regimes in many cases, and these assumptions can fail. So the real risk is not the volatility itself, but the forced diversification. And portfolios should be constructed around true economic exposure, not just asset labels. In equities, the environment shifts away from multiple expansions and goes toward earnings disciplines. We need diversification. However, we have to be very careful because the valuations have been increased very recently. We haven't seen lower prices for a long time. So we are not entering a crisis, but we are clearly exiting an era of free money, predictable correlations, and passive certainty. The next decade will still offer returns, but they will earn through disciplined valuation work, asset allocation, understanding the constraints, the politicals, and the real assets. And just keep in mind that geopolitical tensions will be a routine. The only certainty is the uncertainty. So we have to be careful.
So very, very clear. We have to be careful. That said, I'll come back to my question. Yes, go ahead.
Something to the Asia debate that we're having. So it doesn't just have to be the developing parts of Asia. If we look at the developed parts of Asia, for example, if we take Japan equity markets have been doing exceedingly well for the past couple of years. And the reason behind that isn't that Japan has suddenly been exhibiting exorbitant rates of growth. It's because for structural reasons, for regulatory reasons, the local equity markets have been suppressed. And once the government made the structural choice to move away from this suppression, to allow for change in the governance of companies and to protect minor shareholder rights more vividly, we saw the Japanese equity markets transform. And that's a transformation that lasted for a few years, and it's still in full tilt because there's still a lot of work to be done there. And that's also evident by a lot of the private equity houses now moving in Japan, setting up offices, and making a very, very long-term commitment towards Japanese equities. We see more or less the same happening in Korea. They were facing the same kind of regulatory issues when it comes to the protection of minority shareholders. Now that's changing, and the stock market is starting to behave accordingly, even though there are some political differences. And it doesn't have to be geographical tilts as well. It could be even sectoral tilts. For example, if we take China and the US, we all know that there is a lot of there are structural issues there politically, and they are going to remain. That it's going to be very, very bumpy right ahead. But if we look at biopharma and investing in biopharma globally, so the Chinese biopharma ecosystem is playing a key role as a global engine for early stage new asset generation. So from 2019 to 2023, investigational new drug applications went from 700 to around, if I don't remember this wrong, 2,000, or even a little bit more than 2,000. And Chinese companies were registering about twice as many first-in-human antibody trials than US and Europe combined. So we have to remain very, very well aware that even though there are certain countries that are still in their developing phase, there are certain aspects of said countries in their equity ecosystems that are very, very far ahead than the competition globally. So there's definitely reasons to allocate more heavily there. And there are even geographies that might not look as developing as others, but there's definitely a lot of value to be extracted from them as well.
Okay, pharma, biotech, key theme, point well taken. I'd like to go back to the sort of seeming contradiction between risk and fundamentals. Nektarios, you have a value approach. You look at fundamentals. One could argue that if we look at fundamentals, EM is probably where they are stronger right now, if I abstract from tech in the US. Yet, this is all an area where, and we heard it, there is significant risk, regulatory risk, capital markets risk, perhaps even risk of being able to bring back your assets if we go into a world with new capital controls. Would you agree that the fundamentals would favor that part of the world? And if so, what would be the way to extract that value in a portfolio that you would build? What would be the optimal way?
Absolutely, I agree. So if everybody allows me, I will go back to the initiation of this discussion, of the panel discussion. So when there is policy predictability and a microeconomic tailwind, that's where our money wants to go. Especially if a regulation doesn't really provide constraints, like Evangelos mentioned very briefly before. So it all culminates to a sound business environment, perhaps with growth, or at least with a mispriced cash flows, if we should be talking about equities or even credits. So I agree fully. It doesn't, like Panagiotis said, we don't really need to assign labels. We just need to understand the underlying risk we want to hedge or the underlying investment opportunity we want to chase. That's as far as public markets are concerned. If we should be talking about private markets, it's a somewhat different setup, but we still observe the same tailwinds, the same asset qualities, traditional asset qualities, like I mentioned at the very beginning.
So let me back to themes here, because Maria Vasalou told us about the emergence of thematic investing, which would be a clear break from what most of us do at the institutional level. We have one theme here, which is value creation in that expanded larger China area, if you might call it. How would you extract that value in a thematic way? Does do we still have to equate geographic equity exposure with the geography where the fundamentals are strong? Or should we find other ways, should allocators find other ways to extract value, to capture that value? Nektarios? Konstantinos? Any views? If we like EM, should we expand our allocation to EM equities?
Absolutely. Absolutely. Yes.
I should. Even if there are,
Absolutely.
and how do I manage then the risks that are inherent to EM exposures?
We really like the bottom up approach. So again, apologies if I should be repeating myself. We would be looking at the sovereign's appetite on debt and policy making that may reflect negatively or positively on their currency. We should be looking at their the environment they create in terms of business investment and what the medium to long-term agenda is. So this is a very good setup. And Asia, as an overall region, but especially coming from the more bottom-up analysis with significant local opportunities, that's something we like and we do recommend, absolutely.
Very clear. We're coming close to the end of our panel. I just have one question from the audience, and I have one last question for you. So my question for the audience is, about whether alternatives. Well, actually, two questions from the audience. The first one that came. One was whether alternatives, and I'll turn to you, Panagiotis, alternatives, word that's being bandied around. Is it overused? Is it too late to include alternatives in the portfolio?
Well, the term may be overused, especially now that it's so much more accessible for every kind of investor, but there is definitely a reason to include it in a portfolio. I'd say now more than ever. So with correlations between traditional asset classes increasing, one must look for diversification elsewhere, especially for diversification that's more accentuated during times of extreme market events. So yes, alternatives are definitely still very useful for portfolios. The opportunity set is always changing, so one must not have a very stagnant allocation. They have to be open to change, but there is still a lot of value to be extracted from various strategies.
So it's not too late, but you got to know what you're doing and you got to be flexible. One more question from the audience. AI. Is any of you deploying AI either at the portfolio construction level or within individual strategies? Not yet? Is it the answer I get?
If you allow me, I will say, so apologies, Panagiotis.
Please,
I'm not.
Go ahead.
Thanks. So we are using AI with our company, but especially in the analysis and business idea generation areas. So we're doing it. Everybody's working on it in the investment team, but surely, like Maria Vassallou mentioned earlier on, there's a lot way to go from the business environment perspective and engagement.
Very clear.
If I may add.
Konstantinos, yes, please, thank you.
Yes, very interesting points from my colleagues. We also have started to use to know what's going on, to adapt, as we mentioned earlier on, to the new developments. How can we extract the value? But one element that we see is that we have to make big efforts, in order to train the system in the way that you want to achieve the answer that perhaps, or the ideas that you have, or the philosophy, let's say. So it remains to be seen, but everybody that starts this journey needs to know that it is not an easy task. You have apply tremendous effort in order to have a good result.
Thank you for that advice. It's early days, and we have to all realize that it's perhaps not the answer to everything. We're coming to the end of our panel. Before closing and thanking you for the insights you shared, the very practical advice going down to asset class specifics, as Panagiotis gave us, portfolio construction from Nektarios and Konstantinos, the importance of capital, the long-term cycle, and capital flows that Evangelos mentioned. Could I ask you to go around and just give literally one sentence of advice, wisdom on what an allocator should have as its first priority, the most important piece of advice you could share for 2026? Let me go around. Nektarios, I will start with you.
Thanks, Théodore. Very briefly, I will quote Druckenmiller, Stanley Druckenmiller, when I was reading it a while ago, when he was asked, what are you guys really doing in that outstanding investment team? So he said, we just read a lot, obviously, research and companies and about investing. We discuss a lot, obviously, apparently it's about investment debates and a corroborative environment, and we wait. So patience for asset owners and asset allocators, patience, but especially alignment between asset allocators and asset owners. That's key every year, especially this year as well.
Konstantinos?
After the awesome answer from Nektario, I could add that we have to be disciplined, to have a cool head, and of course to be open-minded to the burgeoning developments that we see, in order on a clear-headed to see how can we adjust our perhaps strategy in this new era, let's say.
Panagiotis?
So for 2026, the opportunity set is always going to be changing across the investable universe, but that doesn't mean that there are no megatrends that are going to stay the same. Remain very, very risk aware, maintain discipline for deployments, as Konstantinos said. And if you do decide to go into alternatives, as every investor should, whether they are individual or institutionals, be certain about your manager selection.
Thank you. And one last word from Evangelos?
Yes, I would say trust the active asset managers. A lot of money goes to passive ETFs. However, there are a lot of missed opportunities that ETFs cannot discover. Only active asset managers can do it. For asset managers, the challenge is not predicting the next shock, but it is building portfolios resilient enough to withstand a wide range of outcomes, while still capturing opportunity where fundamentals and valuations align.
Terrific pieces of advice. I want to sincerely thank our panelists for sharing, for fully meeting, I would say, the objective of the panel, which was insightful, I believe provocative in many respects, but also very practical advice that stems and represents the more than 100 years of collective, I think, experience that you have managing assets. So, George, over to you to close our conference. Thank you.
Thank you, Théodore, and thank all four panelists. You did a great job. You covered so many topics in 45 minutes, concisely, and giving what you said, practical advice. So with that, we have reached the end of this year's conference on asset management for institutional investors. We had a record again this year. We have been notified we had more than 430 delegates registered from all over the world. We're going to publish, as always, the exact figures on our websites along with the videos. Let me thank our sponsors, The gold sponsors 3K Investment Partners, Alpha Asset Management, IOLCUS Investments, and Piraeus Asset Management. Our silver sponsor Systemic RM, and our affiliate sponsor Alpha Trust. I would also like to thank once again our supporters, Kaya Association, which was represented by Laura Merlini, CFA Society Greece, represented by George Panagiotis, the Hellenic Bank Association, the Hellenic Fund and Asset Management Association, and the University of Piraeus Research Center. I would also like to thank our media partners, Business Daily, Euro, Today, Mono News, and NextDeal. I hope the audience has enjoyed the conference and has learned something new. The objective has always been to bring together cutting-edge academic research with latest developments in the industry and bridge the gap between these two worlds. The Institute of Finance and Financial Regulation is a leading institution in that aspect. It has a unique team of IFFR professionals. You saw examples today. Théodore Economou and Maria Vassallou are among the IFFR professional fellows. And I believe you got also a good feel about the high quality speakers in general we have. With that, please stay tuned. We have launched a membership list. You can fill in your details if you wish on our website so that you enjoy the benefits from being members at IFFR. And please stay tuned so that to get informed about our forthcoming activities. Have a great new year, and thank you once for being with us today. So good morning, good afternoon, or good evening, depending on where you reside. Bye-bye, and look forward to seeing you again soon. Thank you.